As per topic today, Dr. Piotr will share his expert opinion on the subject of social finance and impact investments. With that, I ask that you give your full attention to Dr. Piotr and help me in welcoming him to the front of your screen. Dr. Piotr, the floor is yours. You will have about 1 hour lecture. Thank you.
Thank you very much. Thank you very much, San. Thank you very much, fellow professors. It's a pleasure to have this lecture with you. Thank you for a great introduction. Actually, I'm very pleased and very surprised that I was invited to take part in your International Week, and to be able to have this lecture and to have a previous lecture and the panel that will take place within a few hours. So thank you once more. I will try to share the screen of my presentation. My today's lecture may be not very typical, I would say, because as I was preparing it, I was thinking, what can I say about social investing, about impact investing, and actually I decided to say a bit more about the doubts and about problems and about controversies connected with that way of investing. So unfortunately, I would say that after most of the lectures, you usually, or you are supposed to know more and be sure of more things than before the lecture. I think here it's quite probable that it will be actually the other way around, meaning that I will try to put some questions, some of them with I don't know the answer for, and to make you think about that way of investing, because it is not that easy in my opinion, and many things are not that obvious. Social investing is, by the way, a very interesting topic, because on one hand is a way to include into investment world things that normally belong to other sphere, that normally belong to a more ethical sphere, more the sphere of our views, of our ideas, and not exactly things we are normally, or we used to normally consider or connect to investments. If I'm trying to share my screen, can you see it properly?
Very clear.
Yeah, we can see.
Yeah.
Okay. Social finance and impact investing. The definition on one hand is clear, but on the other hand, I wouldn't call it that way. And what I would like to tell you is that basically the further on we move towards this social aspect, the less concrete the definition becomes. Social finance supposed to be, or is said to be, an approach to managing money which delivers a social dividend or an economic return. What is a social dividend? We hear long years ago, we were using this social dividend definition in a totally different system, totally different economy, which is not the case now, neither in our part of the world, hopefully not in your part of the world, but it was something connected to the socialist system. Generally, social finance, as you of course know very well, is considered an investment into companies who consider themselves social enterprises, who consider themselves or are considered to do something at the benefit of the society. And that's, I would say, where the clear things end. Because what is good for the society, what does it mean to do something at the benefit of the society, is actually not that clear, and also various people have various ideas for it. Of course, social finance should be good for the society. Now you have more and more definitions and more systems how to classify things as social finance or not. Socially responsible investment, which I will mention in a moment. But still, if you are looking for an answer, what is really acting in the benefit of society, I would say we have probably the same number of answers as we have people thinking of the answer. Impact investing, considered to be a part of socially responsible investments, investing into companies, organizations, and funds with the intention to generate a measurable, beneficial social environmental impact. I highlighted beneficial social and environmental impact because, however nice it may sound, it's actually something that is not very concrete, and everybody can have a different idea what is beneficial social impact, what is beneficial environmental impact. Sorry for some spelling mistakes. I can see that there are some spelling mistakes on my slides. Sorry for that. I'll repair it before I will send it out to you. To some extent, it's easy to say that some things are positive for the society or for the environment. If we are considering building a hospital or a sewage system in a place where it wasn't there, it would probably be positive to all of us, unless there were some other issues that wouldn't make it that positive, because various things happen, and even very good and very, I would say, projects that are meant or seen as very good for the society sometimes have their bad side, sometimes have their controversies. SRI, another derivative definition, another derivative way of describing investment that are supposed to bring good things to the society. Socially responsible investing, which is also defined by putting some social and environmental good along with the financial return. Nobody says what is more important, although these ideas and these clauses are generally used to direct the investments that normally are financial driven and try to redirect them into more social, environmental way of helping society, helping people, helping environment. What's in common is that most of the time, if we talk about social responsible investing, some industries are avoided because they're seen as controversial or harmful to the society. The one here, like alcohol, tobacco, gambling, pornography, are more or less obvious, although the definition or the exact definition of these industries may not be that clear. And as I would say, and from my experience, the definition of the social environmental good is not that clear to everybody, and it's not the same to everybody in all the countries and everywhere. ESG, which is a wider sense, it also includes social impact. It includes things that are considered good for the society, but it also involves things that are closer to the company itself, which is corporate governance. And I have to say, being an investment professional, that corporate governance is something out of the three factors, environmental, social, and corporate governance, is something that is much clearer, maybe because it's older than the other two. Corporate governance is usually understood by the mechanism and processes aimed to control and operate a company to make it work in the interest of all its shareholders or stakeholders. I would say it's the least controversial, and actually even being a vice president of CFA Society of Poland, we are doing various projects related to ESG, including conferences, and usually corporate governance is the thing that we discuss the least, and the social part is the part which has most controversies, where most the disputes take place, where people often do not agree with each other. Corporate governance is generally more clear because it's basically about 2 or 3 situations. Is about balancing the company to act in the interest of the shareholders and not only one shareholder, which is kind of one axis of that possible conflict. And the other axis is the management that may like to act in its own interest and not in the interest of the company or in the interest of shareholders. Of course, solving problems is much more difficult than pointing these problems out. So there are many problems connected to corporate governance. And there are also some controversies, which I will not focus here this time. But it's definitely more clear and less controversial than the other two, environmental and social. Coming back to the basics. Some would say that investment process and decision-making involves some ways of investing, top-down, bottom-up, and so on and so on. Let's forget about it. I don't mean let's forget about it at all, especially for the students. If you are going to have an exam, a test from portfolio management, please do not forget about the theory and classics of investing. But what I would like to tell you is that the most important decisions in investing and partially in finance is not made top down, bottom up, is not made by people, asset managers, investment analysts, investment committees. Most important decisions are really made by the clients, by the investors. What decisions do they make? First, whether to invest or not. It's especially in the mutual funds industry where you are not obliged, usually there are some mechanisms, but usually you are not obliged to invest in mutual funds in most jurisdictions. So it's the client decision to allocate its money into the investments or not. And I would say it's probably the most important decisions, because if the client doesn't allocate money or doesn't allocate enough money or allocates less money, all these processes, investment managers, analysts, they don't have anything to manage. If the client decides to take the assets out, what does the fund need to do? Sell the assets, regardless of the situation at the market, regardless of the ideas and forecasts for the market by all these investment people. The other decision made by the client is the decision which assets to invest in. It's usually which categories of assets, asset classes, I should say. So it's the client usually who decides whether to put money into a bond fund, into an equity fund, into a balance fund, international fund, and so on and so on. So regardless of our idea of how professional asset management should look like, it's actually not the asset managers who make the most important decisions, it's the clients. Because as you probably know, usually the rate of return is more on investing or not. Well, it's obvious, but it's more on selecting the asset class in a different moment in time than choosing the stocks, picking the stocks or picking the bonds to invest in. So normally we have the clients who have the most to say. It is true in the funds. To some extent, it may also be true in banking, but nowadays, in many countries, we have to be in the banking system, and our influence on what the banks are doing is quite limited. These banks are more or less publicly listed, so that's the channel where the investors can actually influence the bank's policy by appointing the directors, by appointing the management board, and then the management board manages the bank. But it's difficult to get the money out of the banking system. And also, if we have an account with a bank, we don't have an influence on what the bank is exactly doing with our money, what sometimes may cause some problems, and sometimes the banks have a problem with making their decisions. So generally, I would say that social impact investment, or basically any other investment, can be done or can be activated, can be started three ways. It can be done by the client, so the owner of the money. He or she can choose the fund or other investment vehicle that invests the money in a way that the client/investor likes. And I would say that from my perspective, it's actually the best way. Although I will not, probably I'm not here in the majority. It can be done by managers of the fund or the vehicle who discretionary choose their way of investing, whether it's about social investing or kinds of social investing or any other investing, including investment constraints, including sector focus. And they may or may not announce it to the client. If they do announce it to the client, it's basically, it switches into the client's decision, because the client can choose whether to stay with this investment vehicle or to move to another one, because, for example, the client may have a different idea about things that are beneficial for the society. Social impact investment can also be enforced by the law or other regulations which require from certain investment vehicles to invest according to certain philosophy or certain rules. This is something that wasn't happening some time ago. Now it happens in more and more countries. In Europe, we have a strong trend going this way. In some countries, we already have it, like France, where certain funds are required to invest only in companies where you have certain ESG rating, which includes also the social aspect of investing. In some countries, you don't have it, but our European Commission, which is kind of a regulatory body for European Union, is making strong steps towards creating a similar environment within the EU. What are the issues, or at least what issues I see in such approach? When it's the client that makes the decision, the client can make the decision according to his or her vision of socially desired projects, of good for society, life philosophy, political or religious views. And if we say about traditional finance or financial mathematics, is actually a science which is growing, but the basics of the science are constant and basically the same for everybody. We can support various theories, but it's more or less a science. things like what is good for the society, what is desired for the people, for the environment, may differ much from one person to the other and may differ much from one place to the other. Some things can be good in one society or one country and may not be very good in the other one. So if it's the client money and the client's decision. When it's the managers making the decision without informing the client, so they are saying, okay, we have a generalist fund, but we are deciding that we only invest in projects like this and that, because not because of the return, but because we prefer to do it because of our views and our idea for SRI or social impact or ESG. Most of the time it's ESG because now it's kind of together, all the three come together. I would say that they fell a bit out of their mandate. When the government imposes the regulation, it's either the requirement to invest only in certain investments with certain ratings or forbidding certain types of investment. It's basically forcing the private money to be invested in the way that is desired by the government, not the owners of the money. And it basically switches the system and the values of the client to the values of the government, which must not be the same. And basically it will not be the same because people are different and have different views. In most countries, as I said, you still have no strict regulation to invest in along the ESG criteria or SRI criteria, although the world is, for better or worse, moving into this direction. And some countries already have it, some countries will probably have it soon. In the EU, we are waiting for so-called taxonomy. So now we have the regulations that say that it should be invested along with the ESG principles, but nobody knows what does it mean, and there are no precise rules. The taxonomy will set a precise set of rules saying what is socially responsible and what is not socially responsible. And of course, in such an environment, basically the key decision maker on how the money will be invested is not the client, so the owner of the money, is not the asset manager who is appointed, who's got a mandate to manage money, maybe not even the regulator, because the regulator, however it's called, is it the parliament or is it the Ministry of Finance or is it the European Commission, whatever, the regulator will not specify which companies can be invested and which not. We'll set some sort of rules, but the person or the entity that would really have the final word is basically the agency or the agencies or the organizations authorized to, evaluate the companies, evaluate the projects, and give the ratings. And that's a huge power, because if, like in France, there will be a requirement for investing all the assets of certain funds only in companies or projects with certain ratings on ESG or socially responsible investment, then basically the decision of granting the rating to different companies will be decision to include them or exclude them out of investment universe of funds that may manage billions of dollars. And that's actually one of the problems. The other problem I see here, being an investment professional, I've been a professor or a lecturer technically, because in Poland the professor is a title which you can only use if you are granted. So I'm a doctor by the title, now lecturer at the university for a few years, and I've been an investment professional for over 20 years. And what I can see in terms of things like social or ecological investing, we are having a major problem in the industry as such, because we as financial or investment managers, we are educated, we are experienced in basically what we do, which is managing money, investing, business, accounting, controlling, things like that. These are the things we are educated in. That's about our studies are based on. That's our CFA charters or whatever exams we have passed are focused on, and that's what our experience is about. I have to say that if there was a only single way how to manage a fund, let's say even an equity fund, everybody would do it. So there's no one way, but there are standards of good practice of managing money, developed through decades, if not ages, and that's some knowledge, that's some science, that's some craft that we are into. We have experienced, once I tried to estimate how many different companies I have met. And even though I wasn't very active in meeting, at some point in time I was, but it's actually more than 1,000. So after meeting 1,000 companies, talking to their CEOs, talking to their CFOs, and then monitoring their performance, monitoring their financials, you get some experience on how things go regarding the finance, regarding business. And also, regardless of what you can hear from a CEO of a company, sometimes funny things, if you are at the beginning of your professional career, you may think, as I thought, being of your age and being a student, I thought that the people who are CEOs of the companies, they are very brilliant, smart, and 99% of them are honest. Then I realized that it's not really like that, and many of them do things they shouldn't do. Many of them say things they know that will never happen. But that's where the experience is. That's where the education is. And the good thing is that it's measurable and possible to quantify, at least at the level of financial results, at the level of promises of CEOs, not really, but at the level of financials, it is. At the same time, most of us financial managers have neither knowledge nor experience with social or environmental issues. We haven't been trained that way. And starting from the point that it isn't, well, being socially or environmentally good or desired is not a sense of science. It's more a sense of views. If the views are shared by more people, they become standards. But still, it's not something that can be called a science. We don't have experience with that, because usually up to date or until very recently, financial managers were not doing and were not making decisions based on social or environmental issues. They were making decisions based on their economical issues and on their view on different companies and different projects. The standards, as I said, are basically formulated just now. Of course, it's not yesterday, and both E and S of ESG were formulated a few years ago, but it's not decades and not ages. And also, these things are quite difficult to measure. Sometimes they may be even impossible to measure, especially if you are comparing two projects which you consider to be both good, but if you are to compare them and to say which one is better in terms of social impact, it's much more difficult, especially if you don't have experience. So having a lack of education, no or very little experience, and having different views on that. But let's put the views aside for a second. We have a problem, I mean, money managers have a problem in making decisions, and that generally generates a lot of area for manipulation, especially in the cases where you have emotions, where you have, I call it moral sensitivity. And then many people come and try to put a pressure, try to say, using various slogans about, are you with us or are you against us? Are you against the planet? Do you support discrimination? Don't you want a better future for your children? If you want a better future, invest in my project. Is the project the best project for the future of your, my, or whoever children? Probably not. But that's something that is being used by many people who want to have the money on their projects, which they have the interest in. Sometimes the interest is very altruist. Sometimes the interest is very financial. But that's how the discussions often look like. And there is a big thing to fight for. Assets under management account for over 70 trillions. Actually, it's much more because the data is a bit outdated. It's like 3 years old. So I would say now, taking into account the monetary easing that is being done, not mentioning the monetary easing that will be done soon related to coronavirus. By the way, I'm really kind of surprised that we do not see a big inflation, big CPI worldwide because of how much money has been printed. Only the assets have inflated a lot, but hopefully not the prices in the shop that much. So there's much more than 70 trillion US dollars assets under management. And if somebody will put the things correctly for that person, a lot of this money will go into this or that kind of project, and it will be caused and it will not be supported by the mass. It will not be supported by ages or decades of experience and science or craft. There's a great guy on valuation called Professor Aswat Damodaran. I was saying that asset valuation is more of art than a science. He says it's neither art nor science, it's a craft. So definitely he's more right than I am. So we have a craft. Here, in terms of investing in social, sustainable, ecological projects, we don't have it. So we as people and we as asset managers are subject to a lot of manipulation. And the more sensitive the issue, you have more emotions, more marketing, and more pressure from various people to actually make things go their way. And it's actually, in today's world, it's actually quite easy. That slide is a bit tricky. I'm showing it to you to say that it's relatively easy to manipulate the general public, including portfolio managers, including people who you would consider to be very smart. Sometimes they are, sometimes they are not, but they also have emotions, and they also have some sort of herd mentality. As we say, it's very difficult to say no if everybody says yes. And what's often done It's like an obvious fact is chosen that is difficult to deny. And then somebody who wants to make a use of that fact creates a theory that justifies it by certain factors. Because it is A and you can see it on a daily basis, that event is explained by a certain theory. And then there is an impression that it's 100% proven. It's 100% proven that if you buy an electric car, there will not be global warming. If you will not buy an electric car, there will be global warming. It's 100% proven that if you buy this product, the environment will be clear. If you will not buy our product, the environment will not be clear, which is, of course, not really true. It may be a part of the truth, usually a very, very tiny part of the truth, or even not. But that's how the mechanism is done. Then comes the media, especially now, especially in the age of YouTube, Instagram, and all the social media, and also the cyber world. Like even a few years ago, I would be very surprised to be in such situation. I'm sitting around 10,000 kilometers away from you, and you told me good afternoon, and I told you good afternoon, but it's actually afternoon in your place. It's early in the morning in my place. It's now in Warsaw. It's 18 past 8 o'clock a.m. So it's morning, and we have a conference call. We have a lecture, real time, seeing each other. So the world now is very small, and it's very easy to access many people, and we don't need a lot of infrastructure to do it. A laptop with a camera may sometimes be enough. So it's easy to promote various theories, and it's easier to manipulate people. Then, if we manage, or if somebody, we are not doing it, we are not manipulating, but if somebody manages to create some sort of a mental connection within the existence of the fact that it's obvious that environment is dirty in certain things, or people do bad things, or there should be more hospitals, there should be more infrastructure. With the correctness of the theory, then it's quite easy to persuade that some things are necessary, obvious, and cannot be discussed with, because everybody who is discussing it, everybody who has got a different opinion, everybody who has got doubts that it may not be 100% as it is, will be called a denier, will be called somebody that doesn't believe in the fact that it's obvious, because we can see it as we go outside, or even sit in. So the whole story, however, and please don't get me wrong, because my presentation is quite skeptical, and in next slides, I will tell you about various controversies I can see regarding social and environmental investment. It's not, I'm trying to tell you that doing things in the interest of the society doesn't make sense. I'm not telling you that doing things to make the environment clear doesn't make sense. It does, but it's not that obvious which things and to what extent really benefit the society, which things and to what extent are environmentally friendly, which things are sustainable and which are not. And that's something I would like to show you, because we are flooded by unidirectional flow of messages. Do that. This is obvious. We are going this direction. We need to go this. This is the trend. Usually it's only a part of the truth, and usually it's only a part of the story. Few examples. Climate. I'm an analyst, and as my friend says, being an analyst makes your life a bit harder. Being an analyst makes you discuss things, question things, and even if you agree with the principles, you try to look the holes, you try to look for things that may not exactly be right. Climate change, we can see, it's a fact. And as they were saying, gentlemen, do not discuss about the fact. So it's difficult to say for somebody who is sensible and who's been watching weather forecast or weather outside that the climate is not changing. This is the fact. The idea that is caused by human activity, it's a theory, it's a consensus theory. So it's probably true. But if we are strictly into the science, it's not a fact. It's something that is very probable. Now, the idea that the process can be stopped by doing what the countries are doing now. So I'm not saying nothing. Some countries are doing something to limit the CO2 emissions. But the idea that it can stop the process doing what we are doing now is not even a theory. It's quite plausible. But what we hear, and we hear it quite often, that if we stop buying some products and switch to other products, we will save the planet. When we switch from coal to gas, we will save the planet. But wait a second. If I burn coal, there is CO2, but if I burn gas, there's also CO2, right? A bit less CO2, but still there is CO2. And it's nothing about saving the planet. It's actually about putting into our minds and into our investing guidelines and into the regulations set by governments or European Union or other bodies that investing in companies producing this product is socially and environmentally responsible. And investing in that is socially irresponsible. Investing in coal, coal mining, coal-fired power plants is definitely seen as something which is not within the ESG, especially E and S, ecology and social, is not seen as socially responsible. But investing into gas power plants, in some classifications, in some standards, can be socially responsible. Even though we are saying about the same process, including a bit different raw material, being a bit cleaner, but it also depends on the technology. But we are being told that this is bad, this is good. This should be allowed, this is okay, maybe it should be tolerated, and later on, maybe not. And it's something quite dangerous. But if we try to say it, if we try, okay, let's put the facts on the table, let's try to be clear, then there is a big risk that we will be called deniers of the climate change itself. And that's why many people basically sit quietly. And somebody who has got the authority to set the standards, to switch between good and no good, has got a huge power, because more and more funds have a view, have an approach on socially responsible investment. And there will be more and more regulations coming that will require it. And what I'm trying to say is not that it's in general bad to try to support the environment or do things good for the society or for the climate. But I'm saying that it's not that obvious, And first of all, it's good to think before acting. Ecology. I don't know anybody who would in principle be against taking care of natural environment. So everybody is an ecologist. But the way we think of it is absolutely different from other people. Sometimes it's really, really very different. Sometimes it depends on the person. Sometimes it depends on the place. And I remember a discussion in CFA, European Union Standards and Advocacy Advisory Committee, well, where my Swiss colleague from Switzerland says that they in Switzerland, as a CFA Society Swiss, because of the climate change, they want to have 100% of mobility realized, I mean individual mobility, by electric cars. I sometimes like to provoke people. So I said, actually, if you take into account the climate, in my country, in Poland, electric cars should be forbidden. And there was silence. How? Come? What happened? Because electric cars are good for everything. No, they are not. They are not because my Swiss colleague lives in Switzerland, and most of the power production in Switzerland comes from renewables, comes from water. So electric cars in Switzerland are basically water cars or renewable resources cars, because that's where the energy comes from. In Poland, the situation is different. In Poland, most of the energy is produced in coal power plants. So colloquially, we can say electric cars in Poland are coal powered. You put coal inside. So first, if you have electric car in Switzerland, it may be good for the climate if you believe that it's good for the climate, that you do not issue the CO2, you reduce the emissions. But the same electric car in a different country, different place on the world, may have a different effect. We could say that the same car in one place can be green, can be ecological, in the other, maybe not. And the case is actually even more controversial because, as you may know, electric cars are not only pieces of iron, pieces of steel, which most of the car is built of, but there's also more than 100 kilograms of lead. We can say a lot about lead, but not that it's ecological, that it's good for the environment. You need to produce it using a lot of water, by the way. You need to maintain it. You need to utilize it, which takes a lot of resources and is not good for the environment. So it is not that clear that this is green and this is not green. Another case, water, nuclear power production. If you asked people who are into ecology, is it ecological or is it not ecological? You can hear 2 or 3 different answers. For some, nuclear power production is good, ecological, socially responsible. It produces power, it doesn't generate pollution. For the others, it produces a lot of risk. It's not good. For some people, you ask for water power production. They would say, well, water is great, water is socially responsible because it's a renewable energy. The other would say that it's absolutely not. because to build a water power plant, you need to build a dam. If you are building a dam, you are interfering with a natural flow of the river. You're probably flooding something. Sometimes it's actually people's houses. And if you have heard of Three Gorges Dam in China, which was a huge water power plant, it was built by flooding not only villages but towns, and people were thrown away from the houses. Is it socially responsible? Or maybe not? Honestly, I don't know. But definitely it's not that it's clear because it's 100% this way or 100% that way. And I believe each one of us may have a different opinion. Animal products. As I was at your age, everything that came out of animals was considered to be eco-friendly because it's natural. No PCV involved, no oil refining involved. If you were wearing a, now they would say eco leather, so plastic basically, coat, it wasn't eco-friendly. But if you were wearing a fur, it was eco-friendly. Now, most of the people would say that a fur is not green because it involves killing and some cruelty towards animals. Is it obvious? Well, it's obvious that animals are dying. But I wouldn't say that it's obvious that in any standards on ESG, we should put animal products on this side or on that side. I would say it depends on our views, it depends on our ideas. Sustainability. It's a very fashionable word, and it has been used a lot. ESG, S for sustainability, S is for social, but it's also sometimes used for sustainability. Good word. What is sustainability? One definition says about configuring civilization and human activities so that society, its members and economies are able to meet their needs and express their greatest potential in the present while preserving biodiversity, natural systems, and so on and so on. What is that? The phrases that I highlighted. These are slogans. These are slogans which are far from being concrete or precise, able to meet their needs. What are their needs? What are the society's needs? Depends on member of the society. What's the greatest potential? Nobody knows where it is. Ideals for future generations. Wait a second. Weren't we so far sustainable as human beings for last, I wrote 3.5 million years, but actually it's said that we as human beings have been here for a bit longer. So far, we were sustainable. Are we now sustainable? I don't know. And my impression is that nobody really knows. I remember when I was at school, I was taught that oil, it was, let's say, 90s. I was taught that oil on planet Earth will end up within 40 years. So by 2030, we should have no oil. We are into 2020 and oil is still there. I have heard the stories, late 90s, that the coal, in most places, the coal is extracted, will be finished within, let's say, 100 years. What I can read now is closer to few hundred years. Is oil or coal a fuel of future for the next 1,000 years? Definitely not. But what I'm trying to say is that we don't know for how long we will have oil or coal. So saying what things are sustainable and what are not sustainable is something that may differ very much from one person to the other, from one scientist to the other, because even the sustainability as a sense is not something that is precise. So how can we incorporate it into investment policies? Of course we can, because we have standards of ESG, we have standards of SRI. But the thing is that the key people here are the people who actually build up the standards. And often we are subject to, if not manipulation, we are subject to being driven into certain directions because we are said that this is sustainable, that makes us survive as a human race, human civilization, and this is not sustainable because we will not survive. So far we have survived, and it's really big money behind that stuff. Another thing that is quite difficult to evaluate, and I would say everybody has got, or everybody might have a different opinion: diversity. We had a big discussion about it quite recently, especially regarding a report our diversity committee in CFA Society Poland have done. But we have, it was about sexual diversity, so men against women. And we had a big discussion, and I would say it was even a dispute because the opinions were sometimes quite different. Because diversity, if we look at the dictionary, is the condition of having or being composed of differing elements. What does it mean? For us, nothing. What is really diversity? Is a diversity a situation where people into the corporate bodies are chosen by their sex, by their ethnicity, by their religious, or is it from different point that they are different, not in terms of how they look like or what is their sex, but what are their experiences, what is their education, how does that mix together? Is it our sex, our ethnicity, our religious or political view that makes us diverse, even though, let's say, there's a 5-person board of directors, which are either all men or all women, and they have graduated, no, sorry, 5 people is diversified, so there are men and women, there are people of different ethnicities, different religious, different political views, they vote for different parties, but they all finished one university and they all worked for 10 years in the same company. Is that management diverse? I would say if our view of diversity is more about justice for all, so everybody has got the right to be in the management, then probably it is diverse. But if we see diversity from the point of that company, the management is not diverse at all. Why? Because if we have people with the same background, the same education, the same experience, their ethnicity, their sex, their religion doesn't make that much difference. More of diversity would be if there would be people in the board having different experience, having different education, coming from different structures, different management systems. That will be diversity from the company perspective and not from the social perspective, meaning that everybody has got the right to be in the management. By the way, the question is whether everybody has got the right to be in the management. That's another question, because the management is in most of the companies chosen by either the shareholders or the representative of shareholders. So if you have the Anglo-Saxon board structure, you have the shareholders and then you have the board with executive and non-executive directors. So it's directly. If you have the continental system, you have a shareholders meeting, you have the supervisory board, and then you have the management board elected by the supervisory board. So the supervisory board members are non-executive. But
perhaps we have you have another 5 minutes to wrap up.
5 minutes. Okay, thank you very much. So in such case, at the end of the pyramid, you have the owners. And the question is it about the owners who have the right to appoint people who they believe will bring them more money? So shareholders look for people who bring them more money for the company, or is it a matter of human rights? Big discussion. And of course, big controversy, especially for the shareholders and for the owners. Similar case, although even more controversial, maybe with labor. Everybody would agree, or most people would agree, that labor should be exercised in fair and safe conditions, good remuneration. That's clear. But if we start to discuss about whether locating factories in very low-cost countries where people earn tiny money and they produce something which is sold in Europe or in the United States for a lot of money, whether that's ethical or socially sustainable or socially acceptable, then you can also have different opinions. I would say definitely it can be positive because you still pay a market price to people and you improve their well-being. And actually in such places, look at China, like 10 years ago, they were working for pennies. Now they are working for much higher salaries. But it's not that obvious, especially with certain people. Is bringing visitor workers to work for low remuneration for each country is ethical, like it's done in the Middle East? Another thing which can be discussed. Arms production, controversial. Some people say it's definitely not ethical, so it shouldn't be considered social or sustainable. But again, do we have the right to defend? What about producing arms for police, for law enforcement? Then we have another story, because police in Switzerland and police in North Korea is probably a bit different standard. And if we talked about whether it's ethical to sell arms to police in Switzerland, well, maybe for me it's maybe not the best case because I got caught for some traffic violation in Switzerland by the police. But generally, we would probably say that selling weapons to Swiss police is at least a bit more ethical than to North Korean police. Is it unethical to sell it to Switzerland, which generally respects the human rights? Another discussion. And you have a lot of other issues which are even more controversial. You have issues related to religion, you have pornography and the definition of pornography. Alcohol is more clear on the definition, but in various countries, various people have different attitude to that. Gambling, prostitution, abortion, and all the other stories. And I would say that having a social approach is something that is beneficial. Having an ecological approach in investing is something that is beneficial. But it's definitely not something that is simple. It's definitely not something that is obvious. And my personal opinion is that it's actually the best way to deal with it is to have as more information given to the clients and the choice to be given to the clients and not to be forcefully imposed on funds to invest along with certain views, mostly by either government or activists of various kinds. And at the end, I would show two. Actually, there are two quotes, but one of them I don't remember who said, so I wasn't putting as a quote. I think the Confucius said that if you can only do a small good thing, still do it because it's a good thing. But on the other hand, everybody who tried to build a heaven on earth, everybody who tried to bring a situation where people will do only good, in our case, where people would only invest in ethical, ecological, socially sustainable companies, projects, and products, everybody has finally ended up building a hell on earth. And most of the totalitarian systems you know about were started by somebody who was trying to build a heaven on earth. And I don't think it will ever be successful. And I don't think we will ever be able to have such an approach to social impact investing, to ecological investing, that we would have one single view and we have one single way showing us what is good to invest in and what is not good to invest in. Okay, as my time is coming, thank you very much for your attention. If there were any questions, I would be pleased to answer them.
Okay, thank you very much, Piotr, Dr. Piotr, for your very good presentations on the social finance and impact investment. The last points that you made is very interesting, actually. There's a one old proverb, I think, in English language, which say that the road to hell is paved with good intentions. So
that's right. We have the same saying in Poland.
Yeah, so the road to good intentions, the hell is paved with good intentions. But basically, before I let to the floor to the students, basically want to ask questions on you. There's a couple of things that's actually interesting from your presentations. In particular, on the subject of the manipulations of the impact investments. You mentioned about the historical evolutions from the social responsible investment to ESG investment, then impact investment. And indeed, most of for those of us who are actually quite unfamiliar with this type of impact investment, it's the social finance and impact investments is more like a so-called politically correct investment one. And the second, it appears there's also like the trend in the green bond, for example. Yeah? There appear not only there is what we call as a green bond washing. Perhaps there is also what we call as a social finance washing or impact washing in the terms of the social finance and impact investment. So, but there are several things, that we want to clarify basically from your presentation. One is there a difference in the business process between impact investment and regular investments? And the second one, perhaps that you can clarify also, what are the instruments? Okay, what are the instruments mainly you use impact investing? Because you experience as also as a venture capital manager, yeah. So normally, venture capital VC usually invest in equities for startup or for say non-socially responsible investments or something like that. But is there any difference in instruments when they're doing, for example, impact investing? And the third, perhaps that you may want to elaborate more about the regulations, which is actually quite interesting as well. I heard in UK and in several other countries, particularly in Europe, there are what we call as the board of impact investments. So in a sense that is basically a specific, there is a specific regulations regarding impact investing in the UK. What they're basically doing is creating an environment where the current government policy can support the growth and the development of the impact investment ecosystem. And perhaps you can elaborate more on that. And the final one, from me, I'm sorry. What's going to be the impact of it's more general one on investment. And basically you mentioned about how the price of financial assets is basically overvalued due to this COVID pandemic, where the government basically injected a lot of fund, a lot of capitals to prop or to support the financial system. Now the question is, what will, I mean, like the COVID-19 pandemic in that you see that globally will affect the asset allocations, also the portfolio selections of the investment, not only in Europe, perhaps globally. That's for me. Before you answer that, there's one participant that's already asked questions. I want to ask the questions. Can you raise your hands again? Tadi, I mean, like anyone? Yeah, Jason Fiorenzo. Please, you can unmute yourself and then ask questions, Jason. Go for it. Jason, are you there, Jason? Jason, where's Jason? Okay, just 1 second, Jason. Ask to unmute.
Oh, hello.
Yes,
Hello.
you can speak.
Yes, it's an honor to ask a question here. So one from the presentation, there's one question that I want to ask. What is your vision about the future of investment, like after this COVID-19 period? That is the question from me. Thank you very much.
Okay.
Thank you, Jason. The other one, I think from Brian Lim, is asking you, Dr. P, what is the most controversial problem with investing in the COVID-19 pandemic? So basically the same as my questions before, that can you elaborate more about this portfolio selections, the assets?
Okay, I will try.
But then,
I hope I
thank you,
will be,
yeah.
I will manage to memorize it all. So starting from the first question, as far as I remember, you answered about the different financial instruments regarding the socially responsible investments. I would say that, of course, there are special instruments like green bonds, which are related to that. Although you also have to say that in case of green bonds, there's a lot of greenwashing going on, and I will elaborate on greenwashing in a second. But I would say it's mostly not about the different instruments, because the instruments are mostly shares and bonds, so the instruments may be the same, but the SRI or ESG standards have an influence on investment universe. So the companies a portfolio manager may choose from, because some of them may be restricted either due to the regulation of different countries or the regulations or different companies managing assets, or are simply restricted by the clients, because also if you are getting a mandate to manage a fund as an asset manager, the mandate says that you can invest in this and you cannot invest in that. So you have certain constraints that you need to follow. And it's actually quite good because it's a clear view. If you have a view of your client, that the client doesn't want weapons, doesn't want this, doesn't want that, and it's clearly said, it's good, because you as a portfolio manager do not need to go into that and to evaluate yourself things you don't have any experience with. It's like my friend who is managing a Sharia compliant fund in the Middle East. There are certain rules regarding Sharia compliance, right? My friend, he's not even a Muslim, but hopefully he has got a board in the company of people who are deciding whether that company is Sharia compliant or isn't. And the good thing for him is that he doesn't need to go into Sharia compliance. He simply asks the board, can I invest in this or not? The board demands some information from him about the company and then makes the decision. And that this is quite clear because there is a client, the board is kind of a representative of the client, and the board says that does follow into the investment universe, that doesn't. It's quite a clear approach. The worst thing is if you as a portfolio manager need to go and to evaluate whether something is ESG or not, whether it's SRI or not, whether it's Sharia compliant or not, especially if you don't have experience and knowledge about that. So I would say it's more about the restrictions if it's done the wise way. So it's restricted not to invest in certain companies, certain industries, but you can use the instruments you usually use, and you can concentrate on portfolio management. And this actually, I would say, this is quite a good way. The way that I would say it's a bit worse is that you are given an approach that you should invest responsibly and you should invest in ESG or socially responsible companies, but you are not said which companies are supposed to be socially responsible. And then you have the problem because you have to interpret it on your own, and it's always, you know, it's not something about math that you can say, I'm sorry, I did this because A times B divided by C equals so and so. So everybody can come and say that actually you've done it the wrong way. And I think I was managing the first pension fund in Poland that adopted some sort. It was not ESG, but it was a similar socially responsible, ethical investing principles. But there were not many principles actually, and we at the fund, we had to analyze whether it's considered to be socially responsible and ethical or not. And there could be also another board member coming saying, but my opinion is different. And then we had a discussion about the issue we had no idea about. So that's something I would say that is worse than the approach number one. Regarding the regulation, I would say that most of the countries go somehow in Europe, in European Union, they go somehow into the regulation. We are also saying that European countries, European financial markets are quite over-regulated, and the regulators try to regulate it even more. So I remember having some meeting with European Commission. We have a law called MiFID, Markets in Financial Directive, and we had MiFID 1, MiFID 2, and now they are discussing MiFID 3. And I said, sir, I'm not sure whether we will survive MiFID 3 because we are already over-regulated by MiFID 2, and it's difficult to handle it. So I would say that, unfortunately, European Commission will go into this taxonomy issue, so we will have it regulated on the European level. So it's, let's say, the top level. In the meantime, France, UK, plus some other countries, they moved with the regulation to require certain investors to use socially responsible or ESG principles in investing. I think the most restrictive here is France, which I mentioned. You mentioned UK, which is also the case. I'm not sure which exact way UK will go because they have exited European Union. And honestly speaking, if I was British and if I had something to say in British policy, I would try to go into a bit different direction than in the EU. And not because of my political beliefs or something like that, but their opportunity, I mean the British opportunity in financial market, is basically having a bit better, less regulated environment, enabling investors to do what they are not able to do within the European Union. Because if when UK was in the European Union, they needed to adopt the EU acquis communautaire, the European law. Now they are out, so they don't need to adopt it, but they are still close, and geographically they are still in Europe, and they were also treated as a base for the world capital. London was one of the financial centers for the world. So I would say that their opportunity would to be a bit different than Europe, a bit more investor friendly, to actually keep the funds in London and not to make them move to Frankfurt, Paris, or Dublin. Now, there were questions about COVID and financial
Yes.
markets, the instruments that may appear or disappear after that. I would say that
Yeah.
the situation is different than
But Piotr, in particular, mm.
yes.
Sorry, bandwidth
Sorry,
problem. But
Piotr,
basically, I mean, like there's something. I mean, like with this global pandemic of COVID-19, there's a tendency for people basically to justify the impact investment in social finance in terms of like the COVID-19. So they, for example, they say that this investment in sanitation, for example, in their hydropower is not only can be used for monetary purpose, I mean, like to get to save for revenue for interest, but they also say it's actually part of the one of the area to tackle handling the COVID-19 impact. So I see, I mean, like particularly in Southeast Asia, I see the growing of the impact investments due to this COVID-19. Do you see that in particular in Europe as well, that trend to going on that directions?
I think not much. Definitely, you will have two trends, in my opinion. One trend is keeping the real value of money. I think more and more people are now afraid of inflation, of CPI, because the government is putting more and more money, is printing more and more money pretty much everywhere. And even before, you had this monetary easing, but the money was going more to the banks and was going to companies and ended up in financial system. And that's why we had this bubble where assets were going up. Sometimes all assets were parallelly going up, stocks, bonds, commodities, and everything. Now the situation is a bit different because now the governments need to give money to people, need to give money to citizens because there is a problem. In different countries, there is a different level of that problem, but the problem is the same, that some people have lost their jobs, some people have lost their revenues, and they still need to be able to buy food, to buy medicine, and to survive. So the governments will put more money directly to the people. So I think we will see inflation very soon. So investors are first looking into investments that will save the real value of their money. And I would say that's probably number one trend, which I expect. Number two is definitely chasing for the COVID. So the companies that are somehow connected with pandemia, the companies which try to invent a vaccine, the pharmaceutical companies, investors are thinking which companies they should invest in from that sector, because if they invest in the right company, the returns will be huge. Because if somebody will have a vaccine or a medicine treating COVID-19, the company will skyrocket, and everybody who is a shareholder will be quite rich. But this is kind of a micro trend. It's not that world's assets are going to small pharmaceutical companies that maybe invent something connected with COVID. So I would say the risk now is the risk off rather than risk on. Investors are looking for ways to protect their capital. I don't think there will be much change in the structure of the market, meaning in the instruments that are there. I don't think that investors, and I do not see it actually, that investors are more into impact investing now than they were before. I would say they are more into investment into COVID-related companies, but I wouldn't say they are doing it because of the impact. Of course, some companies are doing it, and probably sovereign wealth funds are putting more money into pharmaceutical research to actually make it possible to have finally the vaccine for COVID-19, to have the medicine, and to be able to recover quicker. But I would say many funds simply invest in such companies because they believe they will earn a lot of money if they invest in the right company. Definitely the change which we'll see, and we are seeing now, is that more and more things are happening online. And I think that because of that, we will also have some mergers and acquisitions on of stock exchanges, and maybe we will have less stock exchanges worldwide because the data transition among different markets, different time zones is definitely much better, much quicker and proven now than it was a year ago. And that's definitely something that will have influence on the market. The same, I believe, there will be less office space occupied by financial institutions, because now we know that we can work from our homes. Before, it was difficult to imagine that there will be an active investment company or even a bank, although in the bank there's always somebody on the spot, but there can be a financial institution working normally where everybody is at home, at least for a few days in a week or then in a month. And that's something that will change, because before it was difficult to think, how come nobody is in a company and the company is working? Now we see it's possible. I'm here, you are there, and so we are at the same lecture. So that's something that will have an influence on financial market. But honestly speaking, I don't think within, let's say, 10 years or 15 years, we will have a fundamental change in financial instruments related to COVID-19. I think, of course, we will have a bull market. We will have economical difficulties, especially in the countries that suffered a lot, either due to COVID itself or due to the lockdown, because it's also a problem to what extent to lock the people down, because on one hand you are trying to save them from dying on COVID-19, and on the other hand you need to remember that they need to work because they need to eat and they need to pay their bills. So it's also kind of a complicated problem. But financial market wise, I don't think there will be such a fundamental change in the instruments itself. Definitely, it will be a change in the way financial institutions are operating and the stock exchanges are operating.
Okay, thank you, Dr. I mean, like last question, perhaps it's quite interesting. It's actually a question from Stanley. Yeah? What are the impact of the upcoming U.S. elections for the capital market? I mean, like judging from the New York Stock Exchange, for example, they've been growing. I mean, like although a little bit for a couple of, for I think this past 6 months, and from the theoretical perspective, let's say that market is actually advanced and everybody actually priced in the what's going to happen in the future. So can we say that basically the market predict that who's going to win, or what's going to be the impact if somebody's going to win? I mean, like this is.
Well, I don't know for sure who's going to win, because if I knew, I would be a very rich person. Well, I think
the market has this prediction path.
I think market has a prediction for Trump losing the elections.
Yes.
And normally probably the market would assume that if Trump is not going to be at the helm, there will be a bit less economical stimulation in the US. But now, in the COVID situation, I am not that sure whether the Democrats will not continue to stimulate the economy simply because they don't want to enter into the catastrophe. And the situation in the US, especially East Coast and some cities in the West Coast, is not very good. And at least as I talk to people living there, they are telling me that the situation is much worse than I can hear in the media. So I think they will definitely try their best to stimulate their economy. And also they will be encouraged to do it because they managed to exit the subprime crisis by strongly stimulating the economy. So they did something what was unconventional. Many people, including myself, were afraid of inflation because they poured so much helicopter money into the market. So I was thinking, okay, we will have an asset inflation, but we may also have a CPI and the problem with maybe even stagflation. That what I was thinking in 2007, 2008, but nothing like that happened. So now they know, or at least they think they know, that they can put more and more money into the market with no consequences on the inflation, and being able to exit the crisis sooner than other countries. So I would think, regardless who is going to win, there will be a very strong stimulation in the US. But I'm not sure how it's going to end up for the global economy in the long term.
Okay, thank you, Piotr. Again, distinguished ladies and gentlemen, colleagues, students, and professors, finally we come to the conclusions of our international series. With that, I would like to thank you for our distinguished speakers again, Dr. Piotr Sieradzan, and for your expert and insightful sharing on today's topics. And I would like also to thank you to our audience, which have been very enthusiastic participants throughout the discussions. And let's do a virtual applause for all of us. Okay.
Thank you very much. Thank you very much, Dean, and thank you all the students. I hope the lecture was bringing something to your approach or to your knowledge, and that you enjoyed it.
Okay. Again, don't forget for the students to fill in like the surveys on the Google Forms, so you can have like the start point again. Thank you for your attention, and see you next sessions of the events. Check out the calendar on Venus Maya. Thank you again. So
thank you very much.
Thank you.
Have a good day, everybody.